Okay, so now how do we put this market neutral strategy together and know what our portfolio return and risk is going to be? So I've walked you through each of the strategies and I've shown you what the return and risk is on each one. Now what I've done is I've created an Excel spreadsheet with the same information. So once we know what percentages in each of these portfolios and we know the return and risk on each one, it's simply math addition and subtraction to determine what the overall portfolio's expected return is and what the highly improbable, say less than 2% potential loss is, and what the more realistic loss potential is. So this particular portfolio, based on historic averages, we would expect to average 9.8% a year, with less than a 2% chance that in a highly improbable market scenario it could lose. A worst case potential loss is 13%, and a more realistic loss potential is only 1.6%. So you get a pretty darn high rate of return for very low risk, and you have it, more importantly, your risk is defined. You know mathematically how much you have at risk, as opposed to most strategies where we're just kind of hoping that the market goes up and doesn't go down. Now, to further prove the math behind all this, we have an independent company called Hidden Levers that does portfolio stress testing for portfolios, much like banks do stress testing for the Fed, to examine various market conditions and say, well, in certain worst case conditions, you can come up with just about any worst case scenario you can think of, and we've got it planned. And what we do is we say, if those worst case scenarios actually played out, how much would the portfolio lose? So here, I've got a sample portfolio that has a very typical asset allocation that we would use for a market neutral portfolio. In the current trending worst case scenarios, that stress test comes out to only -7%. So it kind of proves the point of what we've been showing you in the videos, that we know that we have very limited downside potential. So that's great, but what about upside return? Well, down here we can see what our return potential is. So the blue line is how this sample portfolio would have performed versus a portfolio consisting of 80% stocks and 20% bonds. So we're comparing this to a pretty aggressive portfolio, and you can see how it would have performed relative to the benchmark 80-20 portfolio, all with significantly less risk than what a typical 80-20 portfolio would have as far as risk goes. So now that you've seen all this and you understand the math behind it, you're well prepared to come in and talk to us here at Mach 1 Financial. We look forward to serving you. We look forward to answering your questions.